Hello, everyone. It is Stephanie from Flipping City. You're probably wondering why I am sitting here today with a llama lamp. Answer number one is because I wanted you to click on this video. Short answer number two, I am working from my home office today. We had some technical difficulties with our internet. But answer number three is I'm really excited to be here today, not only because I bought an awesome new lamp this afternoon, but because we are excited to kick off the first video from our new educational series that we are going to be bringing you over the coming weeks and months. As we continue to grow with Flipping City and Flipping City Academy, we want to help you grow your knowledge about different things across the world of investment real estate. There's so many things from identifying properties to financing to just basically everything from starting a transaction to closing a transaction. And today, I'm super excited to have a very special guest. His name is Scott Saunders from Asset Preservation, and we are going to dive into the world of 1031 exchange. So a lot of information here. We're keeping it at a high level because it might be something that's new to a lot of you, maybe a refresher, or maybe you're just looking for someone to partner with as you start to move into the 1031 exchange world. So thank you for clicking on this and taking a quick look to hear what we have to say. We hope that you find this content valuable. Make sure to follow us on all of our social media channels. We are on Facebook, we are on YouTube, we are on Instagram, and we will very soon be on TikTok. Content there might be a little bit more entertaining and not as educational, but certainly fun. So we hope that you get a lot out of this interview. I certainly did. Stay tuned. We will have Scott Saunders joining us shortly, and we will talk all things 1031 exchange. Thanks so much for watching. Good morning, everyone. It's Stephanie from Flipping City. We are here today to talk about 1031 exchanges. We have one of our trusted partners, someone we've done a lot of work with in the past. We have Scott Saunders here from Asset Preservation. I'm going to give him just a minute to say hello, introduce himself, and then we will roll right into it. So, hello. Thank you so much for joining us and taking time out of your day today.
Stephanie, it's great to be with you and to talk about this subject. I'm Scott Saunders. I've been in the 1031 exchange industry since 1988, so a real long time. That's kind of my expertise, and we'll talk a little bit about that today. And then I'm also an investor with you, Stephanie, and have worked with you on a number of purchases, and I'm a big fan of the Memphis market. Love that market, and love working with you and Tomo and everybody on your team. So it's great to be with you today.
Thank you. I feel the same. A little bit of an echo, so hopefully that will fix itself. Let's roll right into it. So we work with a lot of investors. We've been doing this for a long time, not nearly as long as you, so you're definitely the expert in this field. So we're fortunate to have you as a resource and someone that we work with. Let's just start out as, maybe you're a brand new investor, or maybe you've been doing this for a little while. Tell us what is a 1031 exchange and what are some of the benefits for investors?
Sure. At a real high level, a 1031 exchange is called that because it refers to what's known as Section 1031 of the tax code. And the tax code has been around for a long time, and 1031 exchanges, believe it or not, have been around for 100 years. So they've been in the code for a long, long time. And really, investors can take advantage of this tool. Really, it's a strategy where an investor can take their equity, and as a property goes up in value and it appreciates, they can redeploy that into better performing properties. So fundamentally, a 1031 exchange allows people to defer paying all of the taxes that they'd otherwise recognize. So if you sell a property, you've got a whole bunch of different taxes that potentially you'll pay. The first one would be depreciation recapture, which is taxed at 25%. Then you've got federal capital gains, which today are either 15 or 20%, depending upon your tax bracket and your taxable income. There's another tax that was added a few years ago called the net investment income tax. So this is an additional potential 3.8% tax for people that have larger gains. It kicks in at $200,000 for single filers and $250,000 $100,000 for married filing jointly. And then finally, and you're in the great state of Tennessee where you don't have state taxes, but many investors, right, might have state taxes, which in California, they go to over 13%. So if you did a taxable sale, you potentially would have all 4 levels of taxes that you'd have to pay. And at the end of the day, you're going to have your gross equity, you pay all the taxes, and you'll have that net amount. What the exchange does, why it's such a powerful strategy, Stephanie, is it allows you to take all of that gross equity and redeploy it into other property. And most people will go into a larger property, or frequently, if they're in single family rentals, they'll sell one and they'll redeploy it and they'll buy 2, 3, or 4 replacement properties. So it's a great strategy. It's really how real estate investors build wealth. It's kind of a critical tool as somebody that's a long-term investor to keep their equity working for them in properties.
Absolutely. No, that's a great explanation and very helpful. I feel like we obviously work with a lot of investors who are looking for more creative ways to add to their portfolio and really use what they already have in new and different ways. So that's a great quick definition to introduce people who may not be familiar with 1031 exchange. There's obviously a lot of levels. We could spend a lot of time talking about it, and maybe we'll even do a follow-up call for people who are interested in digging a little bit deeper. But thank you for that explanation and kind of just giving us the overview of what the 1031 exchange program is. So you personally, you mentioned you've been doing this for a long time. We look to you as a resource when we have questions about 1031 exchanges. You mentioned you've also worked with us on investment level, so we appreciate that as well. And I work with multiple investors, and we do as a company, who are doing exactly what you just said. They are in the process of identifying properties, and we'll dig into that more in just a little bit. But maybe just tell us a little bit about your company and your background in asset preservation. Give us a little bit of background and information there.
Sure, happy to do that. Asset preservation is what's called a qualified intermediary. So when you do an exchange, you need to bring in what's called kind of a fourth party principal, another company that's going to prepare the paperwork, hold the funds in a separate account. Asset preservation, I'm a senior vice president there. We're based in California. We've got an office out in New York. We've done over 200,000 plus 1031 exchanges, everything from small properties to billion-dollar transactions, with large hotels and casinos, kind of the whole gamut, ranches, farms, commercial, everything that's out there. So we act as a qualified intermediary. We happen to be a subsidiary of a title company, and that's really important because we've got their financial backing and kind of the corporate controls that go along being a subsidiary of a publicly traded company. So that's what we do. Now, one thing I just want to let you know, Stephanie, right? We're a resource. So investors should certainly consult with a qualified intermediary, get input, get guidance on the process and what can be done. At the same time, we're not allowed to give tax or legal advice. So we really kind of work in conjunction with an investor's CPA or tax advisor. So we can talk about the process and the time deadlines and how to do an exchange. But it's really important that an investor talk with their own CPA, make sure they look at things like maybe the entity, how they're holding title, how they want to purchase the new property, those types of issues. It's really important to bring in your own tax expert who knows your situation. Make sure that they have at least done a cursory overview and everybody's kind of on board working together with you and your team in doing that.
No, that makes sense, and that kind of leads me to my next question and where I was going with this. And we agree with you. It's very important as an investor to have a qualified CPA, to have someone that you can talk to about everything related to the taxes related to your investment. So it does kind of go hand in hand, and we do have resources available there too that we can refer our investors out to. But I really do want to focus, on the 1031 exchange piece of it today, since we have limited time, and again, we want to be respectful of the time you've given us today. I'd like to talk a little bit about just kind of high level the benefits of doing a 1031 exchange. What capital gain and other taxes could an investor face if they don't do a 1031 exchange?
Sure, happy to discuss that. If you don't do an exchange, I kind of touched upon it earlier, you've got 4 potential levels of taxes that you'd face. Really, what would happen is you sell a property, then you've got to do your taxes on your gain. And the gain, it's a fairly easy formula. It's what you paid for the property. So that's really called your original basis. You add in any improvements you made, and then you subtract out depreciation taken over time. That's going to give you what's called your net adjusted basis. And really what you do is you take that net adjusted basis off of today's sales price less closing costs, and that'll give you your gain. What a lot of investors, Stephanie, are surprised to find out is they may have had a property that they've owned for 10, 15 years, and maybe they bought it at one number and it's gone up a little bit, but they've been taking the benefit of depreciation each and every year. So if they sell it, they may find that they've got a lot more in taxes that they would owe than maybe they were thinking. They're thinking they're just paying on the increase in price. You really pay taxes on your total capital gain. So the exchange allows you to take all of that equity, right? The profit, if you want to think of it that way, your down payment and your profit, and then you can reinvest that into other properties. So real estate investors that do exchanges are going to acquire property faster. They're typically going to get better rates of return, and they'll build their portfolio much faster because they're really taking all of that purchasing power, redeploying it over and over again. So you find that you can scale and really grow your portfolio. So to me, that's a huge advantage. You know, we've all heard the adage, right? It's not what you make, it's what you keep that matters. And the exchange is a great tool that's available to real estate investors. And you know, speaking to that, you don't have this available on stocks. You can't take your Amazon or Apple stock that you bought at a low price that's gone up and defer paying taxes. We can do that with investment properties. So it's a really unique advantage that's available to real estate investors. And you know, people that are maybe on the sidelines and not sure about it, I encourage you to at least look into the benefits, you know, explore it, learn about the process. Most people are going to move forward with an exchange versus paying the taxes.
Absolutely. It definitely does sound like a very powerful tool, and something, if people haven't already tapped into it or at least explored it, it's definitely worth taking some time, asking some questions, and getting to know someone like yourself who's an expert in the area and can help identify why it might or would make sense to take advantage of this tool that exists out there. So say you're an investor and you realize that you have a property, and maybe it makes sense and it's time to take advantage of a 1031 exchange. Could you maybe walk us through the timeline and what to expect in the process of going into this and moving into this type of transaction?
Sure, be happy to. The most common exchange is what's called a delayed exchange. So there are different formats. We won't get into all the other ones that are out there, but 98% of exchanges are a delayed exchange. What happens is, instead of you selling your property, you contact a qualified intermediary prior to closing. They're then assigned into your contract. They really step into your shoes and become the seller of the property. So the transaction is going to close just like it normally would. It's not going to hold up the closing at all. Transaction closes, and because the qualified intermediary has been assigned in as the seller, they receive the proceeds from the sale. So the closing date is what we call day zero. So that's the closing date. You then have 45 calendar days to identify property. And identify just means you identify in writing. You put it on a form. There are a number of different identification rules, but you'd identify specific properties that you would like to acquire. So you have the 45-day identification period. You then have another 135 days after that, what we call the exchange period. So it's a maximum of 180 days. So 45 to identify, 135 then to close on it. And that, you know, that's typically when they'll be doing due diligence with you, right? They'll be working with the lender, getting the appraisal, the home inspection, the termite, all of those types of things that you need to do to close a property. It typically takes, you know, a month or two, you know, something like that. So you identify it, and then you've got to actually purchase one of the properties identified. So that's really kind of where the time pressure is identifying that property. And you can identify one, or if you use the 3 property rule, you can identify up to 3 properties, and you don't have to worry about the value. So there are a number of different ways to do that. But then we take the money we're holding. We then, as a qualified intermediary, we step into the shoes as the purchaser. So the contract's assigned to us, the money we're holding. We purchase the property, and then it's deeded back to the investor. And that really completes the 1031 exchange. Now, if they don't identify or they don't complete it, they just get the funds back, and then it gets converted back into a taxable sale at that time.
Okay, no, that's really helpful information. And two key takeaways for me. Make sure you are in communication with your 1031 representative prior to closing. It really involved them from the beginning, so you know that you're taking all the appropriate steps. And that 45-day period is an identification period. It doesn't necessarily mean that you have to go into closing within 45 days. So where an investor might feel pressure, oh my gosh, I've got to find this house that's ready to close in 45 days. Am I going to be able to do that? Especially if they're looking at multiple properties. And that's not necessarily the case. It's just a matter of identifying those properties and putting a timeline to those. Am I understanding that correctly?
You're absolutely correct. You're identifying them. In fact, you can start working on the purchase side, working with, you and your team. You can do that as you've got a property you're going to sell. That's what I've done on some of my personal exchanges is, as I'm in the process of listing the property I'm going to sell, I'll reach out to a provider, a property, and say, okay, here's kind of what I'm looking for. So one way to take a little bit of the mystery out of it and a little bit of the time pressure is start working on the identification. Work with a provider like you guys are there and say, here's what I need for my exchange. One thing I just want to mention, there's two basic rules that are very simple. If you want 100% tax deferral in an exchange, you need to reinvest your net equity, and you need to have the same or a greater amount of debt on the property. So that'll allow you to have full deferral. And a lot of people forget about the debt component. So if you're paying off a mortgage, let's say of $40,000 on what you're selling, you need to have $40,000 or more of mortgage on what you're purchasing. And that could be on one property. It could also be split amongst two. So if I got a $40,000 mortgage, I could buy two replacement properties with $20,000 each or more and qualify. So just keep that in mind. And one last piece I'll just mention, you don't need to do a fully deferred exchange. You might end up not perfectly finding a property that meets your exact requirements. So you've got a few $1,000s left over. There's a term in the industry that's called boot, taxable boot. So if you get, let's say, $5,000 out of the exchange, that amount is taxable, but everything else is deferred. So roughly 1/3 of the investors out there do partially deferred exchanges where maybe they don't match up perfectly and they've got most of the tax deferral, but they pull a little bit of cash out. Or Stephanie, what if they want to go out and, redecorate their home and buy some beautiful lamps like you've got there, right? They take a little money out, pay taxes on that, and they still get the benefits of an exchange, and they get access a little bit of their capital.
No, that's awesome. That's really great information to know and not common knowledge, even to people who may already be participating in a 1031 exchange. So it is really important to identify a qualified intermediary. Any tips or suggestions there for people who are getting started and what to look for and how to find the right person to work with?
Yeah, great question. And when you heard the term qualified intermediary, you kind of assume that somebody's qualifying them to be an intermediary. One of the things that's surprising to a lot of investors is that the industry is not regulated at all at the federal level. There's no body, we're not under the SEC or banking, so there's no federal oversight. There are a handful of states that have state level consumer protection rules in place. So Colorado's one, Nevada, California, Oregon, Washington, Idaho, Connecticut, and Virginia. I might have missed one or two. So when you select a qualified intermediary and you do your due diligence, you want to ask them certainly about the security of the funds, right? How do they secure that money? They literally are holding your money during that time period. So it may just be a few months, but they hold your funds. And so a qualified intermediary is going to sit on those funds. You want to ask, where do you deposit the money? Is it in a money market account? Are you depositing with a big financial institution or a little local community bank? Is your company a subsidiary of a parent company? So there are title companies that have qualified intermediaries. Some banks have a qualified intermediary arm. So being underneath an umbrella of a parent company gives you a little bit more security and kind of oversight. And then finally, there is a trade association called the Federation of Exchange Accommodators, sometimes referred to as the FEA. I was president of that group a couple years back. Their website's 1031.org. And so most reputable qualified intermediaries are going to belong to that organization, subscribe to a code of ethics regarding how they handle the funds and how they handle their business practices. So those are some, that's maybe a resource to look at, and those are some questions to ask. But the number one issue is it's your money. Make sure you're very confident with who you're entrusting your money over to. That's a key issue.
Absolutely, no, that's also very helpful information. It's critical for an investor to do their due diligence before they make a decision to go into something as important as this. So thank you for sharing that information. We really kind of took a high-level look at what the process looks like. I want to come back really quick to something that you mentioned, and then I know we're getting close to our time here. You mentioned a qualified property. So when you're looking at doing a replacement property, or dispersing your funds and doing another purchase, what would be that distinguishing factor, and how would you know qualified versus non-qualified property?
Yeah, good question there. So when you do an exchange, you've got to exchange out of what we call LikeKind Property and into LikeKind Property. So LikeKind Property, the simple definition, just to keep it very simple, is any property held for investment purposes or used in your business. So most of the people are dealing with investment property, but you might have, let's say, a car repair shop, and you own the building, and now you're at the point where you want to kind of sell that business and sell the building with it. You could exchange out of that business building into an investment building. Anything that's held for investment qualifies. And so bare land can be exchanged into a single family rental, can be exchanged into a multifamily, industrial, office. So it's very, very broad. Probably the easier way to kind of reframe it from another perspective is to say, what doesn't qualify in an exchange? So there really are just two simple categories. Number one, the home you live in doesn't qualify. So if you live in the house, it's not held for investment, i.e. rented. The other is property that's held for sale purposes. And so in real estate, we're familiar with a fix and flip, right? I buy it low, fix it up, turn it around for the short-term profit. Those properties, if they're held for sale, are excluded. So you can't exchange your home. You can't exchange a property that you're building for sale purposes or flipping. Anything else is held for investment. So single family can be exchanged into a fourplex, could be exchanged into a vacation home held for investment, could go into industrial. So it's very, very broad. And, I'll expand upon that. You can even do things like water rights. We exchange air in New York City, what's called an air right, or transferable development right. There's a type of product out there called the Delaware Statutory Trust, kind of a hybrid of a security and qualifying property. So a broad spectrum. Obviously we see a lot of investors today going into the single family asset class because it's a favorable one, right? Rents are going up. There's a lot of demand for that. So we see people that maybe come out of a coastal market, maybe they come from the West Coast, they come to Memphis and they look at the return on investment, right? The cash flow that's there, as well as the other components, the appreciation and, just a really robust economy in Memphis. Can you tell I'm a big fan of Memphis? It's a great market, and I think it's a great one. If you look at it, people always ask me, I'll put on my investor hat here, but Memphis has got so many great factors going for it, right? You've got the airport, the biggest in the world. You got the railways, you got the highways, you got the industrial. You have your new Ford plant going on north of town, right? What is that, like $5 billion plus facility? I mean, there is a lot going on in Memphis to make it a great market. So I'm real high on Memphis.
Sorry, I'm still muted. I was just going to say, if you are looking for a second position, Flipping City could use you on our team since you love our city so much. No, but you're right. Memphis does have a lot to offer in terms of just a high demand for rentals. It's definitely a working class city, so I'm glad to hear that you recognize that. So thank you for that. I know we're again getting very close to time, and this has been a lot of really helpful information. I feel like every time I talk to you, not just on a Zoom call, but even just as we've worked together through the years, I learn something new and I take something away. You're just such a great resource and partner with our team. We've hit on a lot of things. Are there any just last minute tips or key takeaways that you would give to real estate investors who are considering this? Just kind of how you would wrap us up and leave them with final thoughts on next steps.
Absolutely. Thanks, Stephanie. What I'd recommend, a couple last tips. Number one, look at your tax consequence before you sell. You can't set up a 1031 after you've already closed. You got to set it up prior to closing on the property. So at least find out what you're going to have in terms of taxes. Many investors are surprised that they really have a bigger tax hit than they were thinking. So that's a really important piece, is to do that and get it set up in advance. The other one I think is really to kind of work with a team approach, right? You want to work with not only your CPA and a qualified intermediary, but as you look for replacement properties, you want to work with people that are familiar with the exchange and understand the time urgency. You know, Stephanie, you and Tomo and your team there, you've done many exchanges. You understand that people are under that timeline and they need to identify. And so as you're looking at properties coming out, you might be able to say, look, this might be a really good fit. So I would say you want to partner together with people that understand the exchange process, understand the lingo and what's going on, and pull them as part of your team. Everybody's welcome to, contact me. We're on the web, apiexchange.com, or our phone number is 800-282-1031. Call us up. We're happy to be a resource. It's a pleasure working with you and your team. You're just so professional in the way you guys approach things. It's a pleasure. I can tell you, I'm an out-of-state investor in Colorado. You're there in Memphis, and yet I feel like the way that you set up the process and make it accessible to investors is great. So you guys are doing so many things so well.
Well, thank you. We really appreciate you saying that, and it's always a pleasure to work with you and to learn from you. So I want to thank you again for your time today, for sharing your information. I will also make Scott's contact information available to anyone interested in learning more about the 1031 exchange program, how to get started. As he mentioned, we have done multiple purchases and transactions with people who have gone through the 1031 exchange program. So we're also familiar with the pressure that sometimes you might feel as an investor to identify those properties, but we have a team in place. We have a plan in place. We're here to help you. Clear communication with your 1031 exchange representative, your local group that you're working with, and as far as within the city where you're looking to invest. Communication is key. So Scott, thank you again. We will share your information, and I really appreciate your time, and I'm sure our investors will have more questions, so we'll probably be sending a lot of people your way.
Great. Well, it's great to be with you, and thanks for the opportunity, and hopefully it's valuable information for everybody.
Very much so. Thank you so much, and we will talk to you soon.
All right.